Testing 1 2, testing 1 2, testing 1 2, testing 1 2. All right. So today, what we're gonna go over is whether or not Domino's Pizza, stock symbol DPZ, is a good investment. How we are going to do that is first we're going to start by reading their 10K annual report. 10K is an annual report. It is downloadable off their website. It is a PDF, free for everyone, not just the stockholders of, because this has to be public information. Now, through this, we can just see what their 3 to 5 year outlook is. If there is sustained growth. Now, it looks like there was a slowdown. This, from 2015 to 2016, you could see fast-paced growth. They probably out-earned what they forecasted. I think they forecasted 4 times a year, probably all 4 times with those kind of numbers. This is honestly not that good news. This kind of drop. You can actually see it in their stock prices now being reflected. There has been some stagnant growth and even some falling in their stock prices. What we're going to do now is go to public information. So DPZ. So we're going to see what kind of effect this had. Now this, if we just do the math here, simple mathematics, nothing too complicated. But if you see, from 1 year to the next, they lost. From 2015 to 2016, minus 12. No, this is not right. All right, I don't know the principles, but just from, they went from 1281 to 1045. They probably missed estimates a couple times. It looks like close to 250 stores closed. I'm going to keep this up. 1281 minus 1045, 236 stores were open comparatively to 2016, where 1,045 stores are open compared to 1,281 stores that were opened domestically. Internationally, it looks like even internationally there was a slowdown. All of this is not good. Year-end store counts, this actually looks on pace. So it looks like there is some profit issues here. Again, that's reflected in the stock prices. As you can see from 2015, where everything was projected at feverish growth, there was just that. Revenues, it looks like, are on pace, actually are growing. It looks like the market, I would say it looks like the market is actually being saturated. Now what we're going to do as we move forward is we're going to look at other competing pizza store chains like Papa John's, Pizza Hut, and so on and so forth. But yeah, it just looks like there is some saturation in the market, in the pizza market. I, for one, enjoy Domino's. Domestic growth, it look, if you see it again, stagnant growth. There is nothing. It looks like we're coming into a cooling off period. As you can see, these numbers, this is going towards 2017, but it looks like back in 2015, where same store growth was at 12%. We're almost we're losing more than 4% from that same store growth. Looks like, again, that would be due to some saturation in the pizza market. Domestic retail sales, it looks like, honestly, is still growing. So it looks like there is some profit issues, some margin issues. It looks like net income per store. See, as you could see, this is a tremendous. It's just a big jump, here. Sorry, I will get better at this, but 192 to 8, 192.8 minus 214 to 17. This was a 21. There was, as you grow, as you expand, you need to build more. Hold on, net income, that would be good. Okay, it looks like there is some good news at the net incomes slot, but again, weighted dilution share, looks like weighted average diluted shares. Yeah, it looks like we're gonna have to keep reading as to why these looks like it's just some general saturation into the market now. As we continue to see, perhaps it is actually addressed in this 10K. I would address some kind of acknowledgement of those two instances. As you can see, the competition is Pizza Hut, Papa John's, and Little Caesars. Internationally, it looks like Little Caesars is less of competition. This is not specifically addressed. Third-party suppliers could be another reason why these margins aren't. So let's go read some of this. For half our annual food spend is nothing. It looks like some of the most important stuff is they have one supplier that they are currently in agreement with on a 7-year pricing schedule. And being that the cheese is their largest food cost, that is extremely important. Something to look out for is the expiration of this 7-year pricing schedule. That tends to move stock prices. Another one is the meat toppings is currently, again, this is that same kind of consideration on costs, right? The majority of our meat toppings come from the majority of our meat toppings in the U.S. come from a single supplier under an extension of our previous agreement. We are currently negotiating for a longer-term contract that would extend through June 2012. That's not great news. That's something that needs to be addressed. Hopefully will be addressed in their quarterly. Um, Coca-Cola is their largest beverage supplier. Um, While we may incur additional costs if required to replace any of our supply partners, we do not believe such additional costs would have material adverse effect on our business. Um, Anything that says we believe, yeah, I have a hard time kind of sticking to. It looks like this could be some of the bulk of the reasoning, is they are in negotiations, and it looks like it is kind of eating into their margins. I still think it is a great. Um, let's see if any government regulations came along. If goes in, would delay or prevent. Again, I think this is no. It may or may not be federal, state. We are subject to FTC. We believe our franchise score. Internationally, our franchise stores are subject to national and local laws and regulations that are often similar to those affecting our domestic stores. Our international stores are often subject to tariffs and regulations on imported commodities and equipment. This could also be another big reason. Okay, so this looks like another big reason on why their costs are going up for the short term. As they aggressively expand, as Domino's aggressively expands into international markets, we see that there are tariffs and regulations on the commodities, equipments, and laws on foreign investments that they're just going to have to eat at the front end every single time they open another store, they create another supply hub. All those things initially eat into their front end costs. That's something that cannot be avoided, but in the long run, you can defer some of those things as you as accounting principles do kick in. We believe our international disclosure statements, franchise offering documents, and franchising procedures comply with. Okay, so they are looking to stay within the lines. We have registered trademarks. Okay, environmental matters, not so much important when you're a pizza business, though. This is something you always want to. Yes, we keep your pizza. Okay, again, the quick service restaurant is highly competitive, and so competition could adversely affect our operating results. Okay, so they do address it here on why there is a stagnant, why they're kind of address kind of future worries. It looks like it's very forward thinking of them. If you are unable to meet our competitive, we would experience downward pressure on prices, lower demand for our product, reduce. Okay, so they do disposable purchasing power, currency fluctuations. Okay, that could also be a big reason. We compete with the fail to see something, which includes opening new, our ability to increase our revenue. Be okay. So right off the bat, coming off. What is this? Coming off kind of just their general introduction. These are, not that greatly worded in tone, right? In tone, they use the words adversely affect our operating results if we fail to successfully implement our growth strategy. It just seems like they are hedging their bets on growth. It looks like preferences and perceptions. Changes in these preferences and perceptions may reduce the demand for our product and harm our business. Reports of foodborne illnesses are bad. Increases in food and labor costs. Operating results. This is a big thing. It looks like inflation, increased food costs, increased labor and employee health and benefits costs. So it looks like just some overall, paying those. In my opinion, this is a long time coming. Um, just another, it's not similar, but something that there I would kind of match it up with would be Starbucks. Would actually honestly kind of be a Starbucks would be a great comparison on what the current the cost they're eating, right? Starbucks, they offer free college and they offer healthcare, and those all affect operating profitability. Um, Another places like Costco, as you can see in America, a lot of these smaller, big name chain stores are beginning to see the advantages of offering their employees some kind of sustained benefits, in both short term and long term. We do not have any long term contracts with certain of our suppliers. As a result, they could seek to significantly increase prices or fail to deliver. This is another. Excuse me. Like I said in the beginning of this, and they did make mention of it, not having long-term contracts with your suppliers is a big red flag. It's something you want to have a assured supply at a certain price. So to take advantage of. This is probably one of the base. This is probably one of the greater things. This and this last sentence here. Labor costs and food costs, including cheese, represent approximately 50 to 60% of our sales as a typical company-owned store. That so the increase in labor costs and the uncertainty of supplier pricing are very disruptive in stock prices, right? Let's see, year to date, it is up here. We are going to have to get some clearances on this, but yes, so year to date, you could see it's up 42% from 191 on January 3rd to 265 on Tuesday, November 2nd, 266.05. So year to date, it looks like 42% is great. That's actually really good. But as you can see in their 5-year, it does look like they're slipping off. It looks like a couple times they tried to beat it. It doesn't look good in this kind of short term, especially going into the holidays. January is typically a time where after New Year's, typically when new stock picks are made. In December, there's a lot more selling in December to free up some cash to buy those cars with bows on it. Just to have some tipping money for how does the saying go? To tip the candlestick maker. Alright, this actually has to do with three men being in a tub. I don't know why that came into mind. But anyways, we move on. Again, they make mention of the dough manufacturing and our supply chain all being very adverse. Our success depends on our brand. We face litigation and negative publicity from listen, I am not inside the boardroom, but I actually have a very great relationship with our local Domino's. I just read some daily headlines and do not see anything make mention of any of this. So I don't know where this is coming from. If this is happening, though, this is never any good. But from someone who eats pizza, it is my preference. It is my choice above the competition. I know it is for many of my friends also. So again, I don't know where it is coming from. If it is happening, it is not happening anywhere near where I can see it. Again, I do not have the eyes nor ears that someone in the boardroom would have, but that is just my general opinion. A lot of the tone of these headlines, these in bold, are, negative. It looks like they are kind of prepping any of these readers to know that a lot is happening. A lot, I wouldn't call negative, just uncertainty. Fluctuations in the US dollar, that's never anything good. Cybersecurity is becoming an issue. It looks like there's some franchisee issues. Government regulation. Current insurance coverage may not be adequate. Significant fluctuations. Our commerce and or may decline. I think if we were to, so this again is saying that there is some rocky times ahead for this business. Could adversely and limit our ability to plan for, okay, we are unable to generate sufficient cash. We are scrutinizing our debt financing. The terms are our securitized debt financing, and certain of our wholly subsidiaries have restricted terms, and our failure to comply with any of these terms could put us into default, which would have an adverse effect on our business and prospects. It looks like that is, why is that important? Debt is something that comes before everything. If you cannot meet your, before let's see, does DPZ pay a dividend? Before any company can pay a dividend, they must pay their bondholders. It looks like they do have a dividend. So before they can pay this dividend of 80% and 83% going forward, their securitized debt must be paid first. Unless and until we pay all our outstanding borrowings under our securitized debt, we will remain subject to the restrictive terms of these borrowings. Securitized debt under which certain of our wholly owned subsidiaries issued and guaranteed fixed rate notes and variable funding senior revolving notes containing a number of covenants, with the most significant financial covenant being a debt service coverage calculations. These covenants limited the ability of certain of our subsidiaries to among other things, sell assets. The securitized debt also requires us to maintain specified financial ratios at the end of each fiscal quarters. These restrictions could affect our ability to pay dividends and repurchase shares of our common stock. Ability to meet these financial ratios could be affected by events beyond our control, and we may not satisfy such a test. This is some pretty bad verbiage. There is nothing in here that has been redeeming so far. It is all very, very negative. A breach of this covenant could result in rapid amortization event or default in the securitized debt. if amounts owed under the securitized debt are accelerated because of a default on the securitized debt, we are unable to pay such amounts. The investors might have the right to assume in a control of sustainability of all securitized assets. Again, this is not good at all. It looks like it could be that it's just some long-term viewing. It looks like their international expansions have not paid out, have not have been less than forecast. It looks like a lot of these I think some of these international openings have hurt them in a lot of ways that they did not foresee. All right, these are just stock prices. Okay, so revenues of company-owned stores. Revenues have gone up year to year, gone up, supply chain, gone up, international franchises, gone up, total revenue has gone up, cost of sales gone up, operating margins. Looks like operating margins have, actually stayed in line. General and administrative expense, again, it honestly stayed in line. Income from operations have increased at a pace that is good. Interest on income, interest expense. So the net income actually looks great. Looks like these company-owned stores, there's some stagnation, not a decrease, which is good. Franchise-owned stores, total stores have gone up. So this slowdown in company-owned stores, it just looks like, again, saturation in the market. And it would be attributable. These are honestly worrisome numbers in my mind. Domestic stores have decreased significantly. Again, this was addressed when they were talking about just ill will, bad headlines being raised. Even against the market as a whole, domestic pizza, delivery pizza. There were 16 openings in the company-owned stores, and there were 213. Total domestic stores. Openings and closings. International stores. They opened 291 internationally. Again, there has been some aggressive international growth since 2014. Income statements, domestic company stores. Some good news would be some restock purchasing by the company. For share repurchase, that could be another reason for price stagnation. Good in the long run, bad in the short run. More buyers in the market as to more sellers. How do I explain this? A net one buyer is bad, right? As opposed to having 100 guys wanting to buy or 10 shares, you have one company buying 1,000. It's good, but it dips the price because there is such a large purchase that to sustain that, new buyers can't enter the market, right? New buyers, you can in the short run, but institutional new buyers, when they enter the market, they don't want to, you never want to depress your own price, your own stock, because of your repurchasing. Stock repurchasing is good. It is the company seeing that their own stock prices are trading at a discount to where they believe the stock price should be. So they take advantage of this by publicly buying exchange traded stocks, and in hopes of when the price does acclimate to when the price does acclimate to the adjusted real level in their own minds, a higher level than what it currently is when it was at a discount, they would benefit from that increase in share price. But like I said, to have one guy buy 1,000 shares is different from when 10 guys would want to buy 100 shares. There is a slow and steady increase there, right? So because there is having one guy buy 100 shares as opposed to 10 guys buying to buy 10, there is no steps. There's no steps to be taken. You don't see the increments of one guy wanting to buy it at the price it's going to be at, and then tomorrow, because of that buying, it pushes the price up. When one guy comes in and just buys, there is a depression in stock prices because the people who are trying in line to buy can't get the price that they want. So there are the new people, the money that comes in that should be new interest is washed out because they can't enter the market. They get frustrated, and by the time the depression comes in of the fact that no new money has come in, just this money that is outright and so big that the market can't introduce pricing that would entice new buyers. When that equalizes itself, the price needs to actually go back to when the new buyers would be enticed or willing to buy at certain prices Typically, that means new buyers won't enter until they see very favorable pricing, and that could also be another reason for this. Again, this little dip, this little hiccup. As we can go to at the height, it looks like it was at 194 is the number that I keep getting. 300. Let's just call it an even 300 to 265, which is a lot. It is about $35 worth of stock points from their high. If you just kind of take a broader view on it, this volatility has been shown in this. It would be interesting to read the 2017, 26. It would just be interesting to kind of see the tone of what their previous 10Ks look like. But to have 1.6 billion in stock repurchasing in this year alone, and the year's not even over, I don't see more. I don't see why. They have had a lot of. That means that there has been a lot of excess cash. It's good for the company. I'm actually surprised that they have such a kind of negative tone. It looks like if we were to read considering this again is not great news. You always want outside buyers. The company had approximately 198.5 million left under its 125 billion authorization as of December 2017. New share to repurchase common stock on 2018. The replaced availability approximately 198.5 million under its previously approved 1.25 billion share repurchasing program. Capital expenditures, equipment. Their new Pulse digital ordering platform. Not have any material commitments for capital expenditures. That's good. Cash provided by operating activities increased. Net income of 63.2 million. It looks like there has been some tax benefits. Their investing activity. There was some debt issued in 2017, which was offset by purchases of common stock and repayment of long-term debt. Looks like they're adopting new accounting principles. Looks like after 2012, and then it looks like in 2020 there are some contractual obligations that need to be noted. 2020, going into this, I would read this year's and next year's to see kind of what 2020, how they're gonna address this large ledger here, this large ledger here, and this large ledger here. I think in the past what sometimes is they refinance themselves here and here. Kind of defer that debt using accounting principles. There's a foreign sheet. These are minute points. Foresee market risk. It doesn't. They're not an insurance company or a financial company. Opinions on the financial statements, financial reporting. All right, current assets. From then to now. Cash and cash equivalents went down. Total assets went up. Construction in progress. Current liabilities went down. Excuse me, I'm coming down with a cold, it sounds like. Revenues are up. Total cost of sales are keep going up. Operating margin looks like to be sustainable. Interest on their expense, never good to have that increasing, but it is just general accounting principles. Net income, earnings per share, dividends declared per share, net income. This is good. This net cash provided by net income operating opportunities is honestly, this number reflects better year to year numbers than from 16 to 17, 17 January 17th, the end of this year. It is much better, which is good. Just some overall thoughts on Domino's as a company. I do like that they do recognize that when there are, general hurdles or just general negative things to address, they do address it, not just once or twice, comprehensively, as we went over kind of the beginning. Even from the beginning, it looked like that, out of the overview, they just kind of stated who they were, what they do, what their plans are, how they make their money, and how they expand. Even as the largest pizza company in the world, they are willing to admit that, outside of just this general, or even inside, but outside and inside, that they can address kind of, this is just another word for saturation. This is how I take it. Just competition, saturation in the market. It's important for especially big companies, leaders of their companies, to recognize and especially in their to their stockbrokers. So as stockholders, to address and kind of the numbers are still very much on the stockholder side. I think just some general headwinds, especially when these what was it? When in 2020, when those debts need to be addressed, I think, and in 2022, right? So in 2020, when this principal debt needs to be addressed, again, I think they're probably just going to refinance. But this is always something. This is a good way to kind of for them to address this big, long-term debt that's due at the end of 2020, and again in 2022, unless they can come up with some serious cash. This is definitely something to watch in the next couple of years, and again in the next couple of years. So, as a whole, going into 2019, I would start to keep an eye on it. I would start reading their quarterlies. I would read, as soon as it were to come out, their 2018 10K. Again, I think the numbers still do it add up as a buy on Domino's Pizza. But it would be foolish not to start hedging your bets, either buying some shorts, buying some shorts, or selling, just outright selling. I think long term, it is still one of the better plays in the pizza market, in the fast food pizza market. And it has shown a propensity to, when it gets out of these and these kind of things are addressed, to have explosive growth. In their 5-year chart, they've had a 290%. That is, if spread out over 5 years, 60% year to year. They are on pace to do it this year. They did it this year. They just fell from their top. Again, this always happens going into the holiday season to free up some cash to buy those cars with bow ties on them. That is my 2 cents on DPZ as a stock. I should say that I am not a financial advisor, or I will. As of right now, I'm not a financial advisor. So please take all of this information with a grain of salt. I do not have. This is such something that I like to do in my free time. Go over stock picks. This is held by Warren Buffett, I believe. Let's see who holds DPZ. Some of the biggest holders in, as of 20, these. Some of the biggest holders in out of Q2 is Jim Simmons, Ken Fisher, Paul Tudor Jones, George Soros sold out, but it is on the map of some big name purchasers, and not on a lot of people, big name purchasers. And you would think for a company that has year-to-date growth of 42%, that it would be, and his name as big as DPZ would have some wherewithal or some reason to buy this. I am still net long on them, but again, definitely keep an eye on how they're going to handle that debt restructuring in 2020 and 2022. If that is not properly addressed, that would be a cause for concern for any stockholder. Yeah, just give me a call if you have some thoughts of your own. Shoot me an email. My email is jasonkim779@gmail.com. I am located in Chicago, Illinois. You can call me if you want to discuss some stocks and some ideas on how and why, why certain things happen in the market. Again, I'm very blue on this. Thank you for your time. That is Domino's Pizza.